ordering in 2023 year to date is down 62% compared to same period last year. And actually, if you look at 2022 and compare that with 2021, new ordering was actually also down. So less and less new ships are being ordered. And the order book today is about 7.1% for dry bulk. So actually close to historical low levels. Also, there's quite a little scrapping being done. I did ask our research people how much scrapping we saw early this year, and they said it was up 100% in January. So that actually means that there was scrapped 2 bulk carriers compared to 1 bulk carrier the year before. So very, very little scrapping going on in our markets. And you can say an owner might invest in 1 extra dry dock for an old ship in a good market, as we have had the last couple of years. But then after additional 3 years, he will again have to do the evaluation to bring the ship through dry dock or do the scrapping. And I think that will probably be a little bit more difficult in today's market to justify in the current market. Even though the current market is good, we also have quite high oil prices and the IMO rules. So I think the scrapping pool is increasing, but at a certain stage, of course, people have to start scrapping the oldest and smallest ships. If you look at the freight market, which of course is also a driver of asset prices, then the spot market has returned to more normal levels as we saw pre-COVID. Still very good levels actually for minor bulk segments, and the overall outlook is actually quite positive especially for minor bulk, but I guess for bulk in general. Demand is of course always difficult to predict and what direction it's going to go, and there will be ups and downs, but overall demand normally increases over time and thereby support our business. But of course there will be shorter periods with lower growth due to lower global economic growth, sort of impacted by inflation, exactly as we have at the moment. So maybe a little bit uncertainty on the demand side, but it looks okay also because China has sort of returned to more normal levels. A wise shipping person once told me that what normally is causing prolonged period with low freight rates is actually always excessive new supply. And you can say with the current 7% on order, new ordering lower year on year, increased scrapping pool, new IMO rules that will force speed reductions, then the outlook is in general quite positive for the foreseeable future, which is also driving up second-hand prices. And actually there is, Morten can talk more about that later, actually there is also very little quality second-hand vessels for sale at the moment. So you can say the freight market at the moment is actually also driving up second-hand prices and probably also helping a little bit on the yards pricing of the new buildings. Like when you then ask about black swan events and that is always difficult to predict. I think geopolitical events, as we have seen, always there, and I can speculate in multiple additional events that I'm sure something will happen that we didn't think about or didn't expect. That has historically always been the case. It's also important that not all are necessarily negative for the dry bulk market. Some of them could also be good. We actually understand, I heard rumors that there's some people who are a little bit concerned about ordering ships in China with delivery in 2026, and especially concerns about refund guarantees and actual delivery and so on. And that might also put a little bit of pressure on the Japanese yards because people rather build the ship up in Japan. There was a question about ship finance and liquidity. I think if you look at traditional bulk ship owners and operators, we have of course all have had some very good years lately. So currently most of us have a strong balance sheet and still supported by a good profitable freight market. So even today's market is actually profitable for most of us. Of course, not as good as 2021 and 2022, but still solid earning and good cash flow. And you can say the thing is that many of us, including ourselves, have paid out very good dividends to our owners and shareholders. And you can say that we as an industry are underinvesting in new vessels, and maybe we just learn from history. But you could say that we are underinvesting. In the old days, we would have invested more in new ships, At this time, for different reasons that we can discuss, we are not. And maybe we also learned a little bit from history in the past. Then obviously financing cost is now up, and that will also reduce maybe more speculative ordering. So you have high new building prices, high interest rates, long delivery time, you have uncertainty of technology and fuels, and combined, all this will limit the new ordering of ships. And I just did a quick calculation. An Ultramax standard, nice ship, but standard propulsion, no scrubber, is probably now around $38 million in Japan for delivery in 2026. And if you estimate a 9% back, then you would probably need to earn more than $19,000 a day for life to justify the investments. And I don't think that's an easy business case to sell to investors or to a board. And if you then start adding special features like methanol, dual fuel, and CO2 scrubbers and bubbles under the hull and all these things, then the price will come up even further. And of course, the requirements to earnings will come up also. Environmental regulations impact on supply. Yeah, we can talk long about that, but there's no doubt that the IMO rules and global CO2 tax and EU ETS and all that, it's all creating a lot of uncertainties, but overall, I think the direction is clear. We have to decarbonize, and there will be no quick fix nor any cheap solutions, but it does change, but it doesn't change that we all in all, we have to decarbonize. Methanol vessels or biofuel looks realistic, practical on minor bulk. We're looking at that ourselves, but it still looks very expensive, both with respect to green fuels, but also to the capex. And you can say the uncertainty on green fuel availability in the early years is not making it's not making an easy case. The IMO rules, they will obviously have an impact on supply. It's still a question exactly how the rules will be, and clearly some issues with the current rules, but that will hopefully be amended and improved as we go along. Enforcement will be implemented from 2026, and then it will clearly reduce speed of the fleet every year going forward, and thereby also a reduction of the vessel supply. Exactly how much it will reduce supply is difficult to say right now, but also quite difficult to imagine that the rules will not be enforced, and it's also doubtful that the rules will be eased from 2026 onwards. And actually, I think it likely will be the opposite. So this will reduce vessel supply further. In Pacific Basin, we hope CO2 tax will be implemented around the world. This is the only real efficient driver of decarbonization, and will make it increasingly attractive to make early investments in emission reduction and so on. But it seems difficult to get the political support to implement such rules and implement a global CO2 tax. One question was also about the technology challenges to improve operational efficiency, and there's plenty of those. But I think we as an industry, we look at all of them, and I'm sure the industry is quite innovative, I would say, and also if required. And I think there's also some good commercial drivers around trying to look at all these operational efficiencies. So lots of good ideas on how to improve existing and new vessels. And some are actually very good, but it's sometimes, at least where I say it, it's sometimes difficult to measure the full effect of each concept, and sometimes nearly impossible to make a financial justification for the various concepts. So I think we're in a situation now where we still look at the financial returns, what is the payback? And maybe we'll have to go over and look at, what are actually the environmental impacts of the investments, but we are not there yet. We still look at the money. Most of us actually still do that. And there was a question about shipyard capacity, and I think it's always dangerous to start saying that there is a lack of capacity. I think currently there's not this will not be a restriction, and I also doubt it will actually be going forward. But I do actually think that labor cost and labor availability at the yards can become a bottleneck for the yards and their capacities, at least in the short term. So I think there's plenty of yards space and room to build a lot of ships, but I do think the yards also have some issues with the inflation and inflation pressure they are on. So in conclusion, again, positive outlook, mainly due to low supply and increasingly difficult to justify new ordering due to technology risk, high interest rate, and very high general asset prices. Quoting a very experienced shipping executive, he always said, "Who in their right mind will invest in minor bulk new buildings with conventional engine system at current prices and with delivery 2026 to depreciate it over 25 years?" You have to be extremely optimistic about the market to justify investments at current new building prices. And not adding zero emission capabilities will increase a large residual value risk. So what is the industry doing? Well, mainly reducing investment in new vessels. So we are actually under investing in new capacity, which of course will support the freight market going forward. So you can say it's a bad thing that we are under investing, but maybe in the short term it's actually a good thing for us who has ships at the moment. And all this will likely only change when we get global enforceable rules about decarbonization and a global tax on CO2 emissions. And even then, the availability and cost of green fuels for the shipping segments will be a concern for years.
Right. Thank you. Yeah. Thank you so much, Martin. Thank you so much. Just one very quick question before I move on to Will Frey for this presentation. You said about the shipyard capacity. Can we say that the tier 1 shipyards are quite busy, be it Japan, China, Korea? It's only the tier 2 shipyards you will still find some capacity, but tier 1 are busy with containers and the LNG ships. Is it fair to say that?
Yeah, I think that's fair to say, yes.
Yeah, okay. Thank you very much. Really appreciate, Martin. Thank you so much. So, ladies and gentlemen, now I take the opportunity to invite Mr. Will Frey. We'll have a presentation for about 20 minutes. And Will is from Maritime Strategies International. He's almost 20 years experience in shipping research and has been MSI's principal main dry bulk analyst for most of his 15 years at the company. His expertise extends into stochastic models. I've never been able to pronounce this word, even when I was studying in Cass Business School. I tell you, and he wasn't very happy, my boss, my teacher. Okay, forecasting. He also oversees the development of MSI's online modeling platform and the utilization of AIS data to estimate shipping emissions and regulations compliance. He has a Bachelor of Engineering honors degree in ship science from the University of Southampton and is a member of the Royal Institute of Naval Architects. Will is also a graduate of Fish Learning's Advanced Certificate in Quantitative Finance. You have the, I made you the co-host, Will. You can share your screen and present your, yeah.
Many thanks, Jagmeet, and thank you for inviting me to this panel today. So I hope we can all see my screen. Let me put that full screen. Okay, I will start very quickly by saying that I'm going to echo a lot of comments from Martin just then. It was a very good introduction to a lot of the issues facing dry bulk markets at the moment, a lot of uncertainty, high costs of new build prices, and that's been a situation broadly for the last couple of years. And it's interesting to also mention that despite a very strong oil tanker market, there's not been many orders of oil tankers either. So there is this sort of period of uncertainty, which I hope my presentation will add a little more color on MSI's view on some of these uncertainties. And I'm sure it'll raise more questions as well in the process. So just a very, very quick background to MSI for those participants who don't know us. We are an independent shipping and offshore research company based in London and Singapore. We are mainly economists, scientists, and academics who specialize in model-based forecasting of shipping markets, covering all markets and also specializing in the shipbuilding sector as well. Now, obviously, forecasting shipping is a fool's errand, shall we say? It's a difficult task, and Martin mentioned that there's going to be some unforeseeable events over the next few years, and I'm absolutely certain that's the case. But in any case, building our models gives us another means to understand the impact of current market drivers, to sense check and do sensitivity analysis on certain issues facing the sector, and also provides us with a method to run various scenarios through our forecast. But what I will present today is MSI's base case view. Firstly, I just wanted to really reflect on the past couple of years, because I think that has a very significant implications for the markets in the near term. And after looking at that, I will look through some more longer term structural changes we anticipate. Our modeling actually forecasts out to 2050, which may seem like a ridiculously long time in the future, but we do that to be able to look at how long-term energy transition and long-term regulations might start to impact the markets at the moment. And when we're looking at our kind of view over the next 5 years, then some of these changes are really important to understanding what the outlook for the dry bulk markets is. I'll also touch on supply response and some of the regulation risks before looking at our outlook for earnings and asset values. So first of all, we saw quite a big paradox in the markets over the past couple of years, in that the actual trade volumes haven't really expanded a lot since 2018. Or on the other hand, the fleet capacity has continued to expand. So if we compare the charts here on the left and the right, then in 2019, 2020, we had fleet capacity outgrowing cargo volumes, and what we can see here is Supramax time charter rate on the right started to fall, and that sort of broadly fits well with this kind of fundamentals analysis on what's happening in the market. But then how did the Supramax earnings, and in fact all dry bulk earnings, become so strong in 2021 and 2022, despite broadly sort of flat trade growth? Now, a lot is related, we believe, to some conditions related to COVID in particular. I just want to focus on a couple of things here. One is the inefficiencies in shipping, particularly in port congestion, and really this is derived from what the land side supply chain issues. So it's really with anecdotal evidence through talking to ship owners and issues that emerged throughout that period of a very inefficient interface between ports, so between shipping and the ports. And there were other issues as well through that period. I think another major one that's been quite difficult to quantify is also the special conditions emerging in the container market, which meant that container freight rates were incredibly strong, and there's a very significant shortage in container tonnage, and a lot of containerized dry bulk cargoes, so bagged commodities or steel, for instance, which had moved to containers, would then find their way back to the dry bulk markets. So whilst the growth in those commodities overall may be flat, a larger share came back into the bulker markets. Now, the issue with these two drivers is that by nature, they are temporary. So as COVID restrictions have declined, then we expect to see the inefficiencies related to COVID then coming off. And likewise, as the container freight market falls back to somewhere near historical norms, then we expect those containerized cargoes that had moved back to dry bulk temporarily then to move back to containers. And it's quite difficult to quantify these, but through our modeling approach, we can do that. But just to touch on the scale of and timings of these inefficiencies, we tried to hunt out some proxies that might help explain the development of supply chain problems. And what we show here on the left here is a index of stringency produced by the Blavatnik School of Government at Oxford University, which is reflecting the restrictions placed on the movement of people through COVID. And through 2022, those restrictions started to be removed. And this sort of coincided with, towards the end of the year, a reduction actually in port congestion. I think another good indicator of inefficiencies also is if we look at the container market into the reliability, the schedule reliability, and typically that's around about 80% as measured by a company called Sea Intelligence, and through COVID that dropped to 20%, 30% as liners struggle to keep to their schedules. Now that is now starting to improve, but it's still not back up to where you'd expect it to be in normal circumstances. It's still around about 60%. So I think there's still a small hangover of these sort of inefficiencies it was such an enormous impact from COVID. It's still having waves in the market at the moment. And we've recently seen congestion also start to rise early this year, but overall the trends are downwards. And this is broadly aligned with that downturn in the sort of long downturn in the dry bulk freight market from a peak back at the end of 2021 to where we are now. So I think this is where we situate ourselves at the moment. Is the market is weak. There are some very positive signals that could be taken from a low order book, from the potential of a Chinese stimulus. You can very quickly talk yourself into a view that the market's going to be very, very strong this year. But we believe that the inefficiencies in the market that were there to really supported those freight rates we see here in 2021 are now being removed. So even if we see some stronger demand signals later this year, we really shouldn't expect to see the freight market jump back to very strong levels. So touching on some of those drivers then on the demand side. Now, there's been, throughout COVID, there was obviously discussion on when and how much would China start to stimulate its economy. And throughout the period, we said there was the prerequisites were lower energy costs, lower raw material prices, and a removal of COVID restrictions. Those are the three main sort of linchpins we thought would need to be resolved before we started to see China maybe implementing some stimulus plan to help their flagging economy. At the end of last year, which particularly important for dry bulk, saw that the housing starts and construction activity really collapse. Now, we have to add to that also the housing debt resilience, and there's been huge amounts of defaults in the Chinese property markets. That's continuing. The Evergrande company will be restructured late this year. There's still some issues evolving there. The government does seem to have put in some measures now to help construction industry by, for instance, removing the three red line debt policy they initiated in COVID. But we are quite cautious here on how much stimulus the government is prepared to place on the property markets right now compared to previous events where they have stimulated their own steel industries. And this is where we start to look at some of those sort of longer term issues which are starting to affect the market now. And one key driver then of China, of the dry bulk markets for several decades now, has been the urbanization in China, and they have a long stated goal to be able to reach an urbanization rate that is somewhere close to developed economies. And we compare here China's current urbanization rate against that of the G7 nations. So by this measure, we could say they are aiming for a long-term target of perhaps up to 80% urbanization as a sort of broad understanding of where we are. Now, the issue is that this urbanization rate, which has been accelerating, will slow as they start to approach this sort of long-term target. Otherwise, they risk producing excess economic capacity and misdirection of investment. So if we look at the potential for stimulus now versus, let's say, in 2008, it's a very different world. And China will maybe stimulate the economy in different ways that are less about building economic capacity, but perhaps more about efficiencies and more about particularly in the energy sector as well. So it's a little bit of a change in focus of any kind of stimulus. And at the same time, we also have signals that the government is trying to take measures to calm iron ore prices. There is a sort of broad understanding that China's steel production this year will probably be flat at best, with some expecting a decline in China's steel production for the third year in a row. So this is all indications of a new phase for China's growth. And then this translates through into a very different profile for China's imports, whereas this chart on the left showing since 2003 a very, very strong rate of growth of imports, particularly for iron ore. Then we're reaching a sort of a flattening phase before we start seeing this actually decline in our forecast. And that may be a bit of a controversial view, but it's not without precedent. So, for instance, in Japan, if we look 40 years ago, we're in a similar situation where they had gone through a very strong, rapid increase in their economic capacity and a lot of steel consumption growth through that period, peaking at around about 1980. And then we've seen Japan's steel consumption starting to decline over time. So China, we believe, is in a similar situation. And this is not the only issue for iron ore trade, because China's also starting to collect a lot more scrap, expecting to collect 265 million tons this year, with a target of 320 by 2025. And this is just our own modelling of the actual availability of potential availability of scrap steel based on a standard kind of lifespan by different sector. And there is about to be a lot more scrap available in China. It does dramatically impact the kind of the structure of trade, which is going to move away from a China-centric iron ore requirement growth into one where China's iron ore requirements are declining. And also in the long term, coal trade will decline as the world moves to meet long-term low carbon targets. So those two engines of growth have started to change. Now, this is a kind of weak story for Capesize vessels, but not necessarily for the smaller ships. So with the energy transition, there's going to be a large requirement for changing and decentralizing potentially the energy markets, where we have more decentralized renewable capacity around the world, and that's going to require some more materials. It's going to require for construction of those particular specialist metals, so more copper being required, etc. And there's also going to be a lot of development work still in Southeast Asia, which rather than them building their own steel capacity, is most likely going to be absorbing excess steel capacity in China. So China will ship out those steel products to help those building works. So minor bulks trade actually overall we believe has got a very strong long-term growth profile, as has grains markets. So in the long run, we have a forecast where coal and iron ore comes under pressure, but minor bulks and grains is positive. On balanced, though, it is a very different growth profile, one that's approaching a kind of flat period for dry bulk trade growth. Now, if trade growth is going to be flat, then we have to reconsider what size of order book then is appropriate for the market. So in a period where the demand is growing rapidly, then you need to have an excess order book to not only replace old ships, but also to build new vessels. If we look at a very sort of a rough top of the end, back of the envelope type calculation, that if a vessel typically has 25 years of life, then you need to order about 4% per year, and with a 2-year lead time, then the order book should be around about 8% of the fleet to maintain capacity. I mean, there is more obviously under the surface here, but overall, this would seem that the handy-size market, particularly if we've got some trade emerging, is going to be in Southeast Asia in between small, shorter routes, and also in minor bulks, then we could argue that the handy-size fleet is particularly under-ordered. But overall, an order book around 7% isn't necessarily is not necessarily hugely under-ordered. We're more marginally under-ordered, and we do expect ordering to come, but as Martin explained earlier, there's many issues sort of suppressing ordering at the moment, and perhaps it won't be until some of those issues are resolved. I realise I've got not much time left, so I'm going to sort of race through the last few slides, if that's all right. Just to say that our own view on contracting is that it's going to take some time for this to start to evolve, and perhaps later in this decade, actually, we're going to start to see quite a big fleet renewal requirement, where a lot of ships built in the early stages of China's huge development in the sort of mid-2000s have started to reach scrapping age. We're hoping some resolution on the potential future fuels and which ship designs are more suited to these fuels. And so this could probably emerge with more contracting later on this decade. One sort of contentious issue of MSI's forecast, though, is that we do expect quite a lot of scrapping, and as Martin says, scrapping has started to uptick to increase, although at a very, very low level. But we are expecting, if we revert you back to the start of our presentation, with the reduction of these inefficiencies, actually we're expecting relatively weak but still quite volatile freight markets over the next couple of years, and we think that'll also push up some more scrapping, as also will some resolution in the finance issues in Bangladesh and in Pakistan, which have really held back scrapping over the past year or so. Plus there's sort of latent scrapping capacity which we believe will maybe be forced into the market as the CII regulations come in, although I think the potential risk is this: if this CII does impact the market and the scrapping does increase because of it, it's probably going to be later on this decade. But if we don't have this scrapping emerging, then the market balances are going to look quite weak for quite a long time. So as you can see here, when we look at our demand for shipping, MSI takes into account not only trade volumes, but also distances and port days and vessel speeds and other fleet efficiencies to calculate what is the required deadweight capacity to meet that trade demand. And looking at the required deadweight capacity, actually it's very flat for the next few years, albeit slight shifting more towards geared sectors. And in our forecast, you can see then the impact of very low contracting leading to low deliveries, plus also higher scrapping, meaning that the fleet actually starts to stabilize and decline slightly and later in the forecast, and that provides some foundation for a market recovery. So that's the background to our view, is that there is a bit more sort of pain to come this year. We don't see a very strong uptick and upsurge from China's stimulus. There's a lot of issues in the world economy at the moment, dealing with inflation, and it'll take some time for those to be resolved. at which time we have China in a structural change to its trading patterns. So the overall outlook then is for a decline this year, and then some minor improvements from next year onwards. But that does also depend on scrapping starting to reappear. And last slide on the asset values. What's been interesting is that despite sort of earnings declining in 22 from a peak in 2021, we had asset values increasing, and part of that is due to a lagged effect of a sustained period of earnings before values start to see an appreciation, but also the impact of the new building markets, particularly on younger tonnage, has supported values in 2022. And as you can see from our new building price cycle, we are expecting new building prices to come off. Now, this might seem surprising given how high inflation is and the increased cost pressures, and a lot of those cost pressures might be here for some time. But we are seeing energy prices starting to come off, and also the underlying sort of capacity constraints we think will start to be released once all of these container ships and LNG carriers that have been ordered over the past couple of years are being delivered, and we don't see a lot of replacement coming in from dry bulk, from oil tankers, from anywhere for the moment. So we think the yards will have to be bringing down their prices over this year, next year, and actually we see the bottom of that new build price cycle happening in 2025. So overall, with a declining new build asset price cycle, with pressures on demand and a decline in earnings, then secondhand asset values we also expect to reduce over the next couple of years. Okay, perhaps I think we might touch on this slide a bit later. Just looking at dual fuel, it's something that MSI has been working quite heavily on, and as Martin's mentioned, we also believe that a kind of global carbon price is an important requisite to be able to support zero or low carbon fuel alternatives. And I think it's important to say, from our own analysis, given a kind of consensus view or something approaching consensus view on the prices for e-methanol and ammonia, you need a very, very high carbon price to make it economically viable. I think there's other rationales to move and contract in zero or low carbon ships, but if you purely look at on an economics perspective, then we think the prices of those fuels will have to come down a lot more rapidly, and/or we have to have much higher carbon tax than what's maybe expected at the moment to really push fleets like the dry bulk fleet, which is very disaggregated, and there's you could argue there's perhaps less sort of leadership, as you might see in the container sectors, to move to low zero carbon fuels en masse. If the economics need to work for that to happen, then we need to see a higher carbon price coming in quite a bit earlier than currently expected. So I'm sorry to run over my time somewhat, but hopefully that's given us something to think about, and I'm happy to help to discuss these further.
Thank you, Will. Thanks so much. There will be a few questions later from you. Just very quickly, you mentioned about the the scrap steel. So what sort of percentage do you expect the reduction in the iron ore by 2025, and whether China has got the electric furnaces as against the basic oxygen furnaces? What do you think?
Yes, well, actually you can use scrap steel in the oxygen furnaces as well. And they have a very low usage of scrap steel, incredibly low usage of scrap steel at the moment. So there is capacity there to increase scrap steel in their blast furnace, as well as developing new electric arc furnace. In the chart I showed, I think if on a tons per ton equivalent, then we have around about, it looks about 40% of Chinese steel production in tons will be collected in scrap steel. So, I mean, it's significant. But as you say, I think there's only so much that can be absorbed. So we expect China's iron ore imports to be declining at a time when steel production is flat, if that makes sense, a gradual decline.
Right. Thanks a lot. Thank you. We'll come back to you later during the panel discussion. So now I would like to invite Ms. Amalia Miliot-Theochoraki and Mr. Simon Ward to give a joint presentation. So Ms. Amalia Miliot-Theochoraki has been the commercial manager at the Athens-based dry cargo owner Theo Shipping Corporation since 2016. Well versed in all aspects of the dry cargo market, she has acted as both owner with Theo and a charter with Bunge in Switzerland, as well as being a dry competitive broker at the ICAP London, following a previous position as dry freight and commodities analyst. This wealth of experience and knowledge is highly sought after at the Institute of Chartered Shipbrokers in Greece, where she lectures regularly to students sitting for the professional qualification examination, what we say PQE. Now, briefly about Simon. Simon Ward is the Director of Sale and Purchase at Ursa Shipbrokers in Paris, Greece. He started his shipping career in Liverpool and has been a shipbroker for 30 years. He was a Divisional Director of HSBC Shipping Services in London and then ran their Greek office for 4 years. He's an active member of the Institute of Chartered Shipbrokers and lectures for them in Greece, as well as contributing to their education committees. Simon also is a visiting lecturer for the University of Piraeus and Athens University of Economics and Business. So maybe have Amalia and Simon, if you can please load your presentation, and then we look forward to listening to you. Thank you.
Well, checkmate, there is no presentation, okay? This is a conversation, okay?
Oh,
so
okay.
we will not be able to hire, no offense to Will, of course. First of all, very hard act to follow, Will, thank you. There is a lot of interesting information and slides and statistics, and neither are our statistics or our graphics good enough to come anywhere near to yours. So what I actually thought, if I can just go straight in, Amalia, good morning.
Hi, good morning.
What I actually thought of when doing this presentation is that when we're looking at things like asset prices and when we're looking at any patterns in the future, what we're thinking about is stories, and the way that the human mind processes information and processes meaning, if you want, is through the narrative structure. And as you can see from Will's presentation, there are lots of graphs and other stuffs there giving a narrative story of where things have been and where things are going. And I think that, okay, I am a shipbroker and we tell stories. This is what we're doing. We're trying to express to the market, to our clients, to our counterparties, to our co-brokers, what things are going on and why things should happen and what the real situation is. So rather than repeat some of Will's very good points, some of which I agree with, some of which I don't, I thought that we should actually have a conversation. Now, I have Amalia with me. He was a very good friend of mine and a fellow shipping professional here in Greece. It gives me an excuse, first of all, not to shame myself in our presentation, but also to have a woman on the panel as well, which is a good thing to have. And I would like to have a conversation, because one of the best ways that we understand stories is by having a dialogue, or dialogos, as we say in Greece. And hopefully out of that discussion, we can add to the further discussion in the panelist discussion. But the three stories that I would like to present to you, which I think are really important when thinking about dry bulk market ahead, some of which Will has already identified in particular. The three stories that are being told in the market over and over again at the moment, as far as the dry bulk market coming, is China is coming back. One story. Second story is demand will catch up with supply. Second story. And the other story, which is more pessimist, is there's too many headwinds. I'm scared. This is not the right time to move. This is all a bit too scary. So, Amalia, welcome and thank you for joining us at the last minute. I appreciate that I have twisted your arm somewhat behind your back for you to join us today. But the first story I would like to get to is this story of China is coming back, and I think, as Will pointed out earlier, there are these. This was a thing in the dry bulk market, especially in the freight market, but the S&P earlier this year, that as soon as Chinese New Year is over, off we go again. Would you agree that that was what the main narrative was then?
Yes. First of all, thank you for having me, ICS Hong Kong, Jagmeet, and Simon, for letting me add to your presentation. We've heard very, very interesting things. And as you said, our conversation, hopefully it will flow in a way that, as you said, we would have a coffee and discuss about the market. And this is what we do on a day-to-day basis as people in chartering or S&P or brokers. Well, how I would think about that is that with a market that has averaged slightly above $9,000 for Capes and $11,000 for Panamaxes for the first quarter of 2023, I believe that now the market is slightly cautiously optimistic amid, as you said, expecting unexpected distortions and disruptions, which we obviously cannot predict. So my view is that most of the participants did not expect this drastic meltdown that happened during December up until February, with Capesize rates lowest in like 3 years, far below break-even points for a long time. And I saw that as a perfect storm due to the aftermath of war, the high inflation, high interest rates, mild winter and high coal stocks, and general slowdown in economy. That don't forget that back then we had this fear of a mega crisis that was still under discussion. And yes, Q1 has always been seasonal, but March had a very big and sudden jump. Like I was looking at it yesterday that at the beginning of April, rates were actually 4 times higher than the beginning of February. That's too much and too high within 2 months. And the question for us now is whether this is too steep and too soon, or will the market actually normalize, let's say for Panamaxes that I'm focusing on, between $14,000, $15,000, $16,000. So yes, this is the question to go, especially when the market, the previous years, has been at an average of $20,000 and $27,000 for 21 for Panamaxes. Now, regarding China that you mentioned, yes, she's leading the improvement in economic prospects due to his decision to end zero COVID policy and now focus on growth. So we expect improvements in consumer sentiment, spending is expected to rise, savings increase during lockdown, and this should help solve the country's real estate crisis, as mentioned before, and boost bulk demand. Now, practically, we do hope for more iron ore import to come. And as Will said in his presentation, a minimum of operational inefficiencies, or minimize at least the operational inefficiencies. So no more delays due to COVID measures, such the problem we had with the crew changes, that was massive problem with respect to not delays of ships and vessels being off hire for weeks and weeks and weeks. Dry docks as well, without having to wait 2-3 weeks. That the ship owner had to spend several $1,000s in lost hire and waiting outside, which was a big problem that we don't have anymore. And as we have discussed several times, the physical market model for dry bulk is that we expect rates to start recovering as demand picks up in China, since it accounts for more than 40% of the dry bulk volumes. But nobody really knows when this will happen. We just keep on expecting, and we kind of form expectations because of this theory. And
which comes
you know,
into which is why the sentiment has been so strong, because especially with asset values, but also with I guess, should we say, the longer term charterers, they want to make sure they jump in before the reality arrives, and so sentiment goes ahead.
Yeah, that's true, and especially the spot market was really waiting what will happen after Chinese New Year, right? As every year. So when I think it was the 5th of March, when China, said that forecast 5% growth, which is relatively low as a target, but it kind of showed the government's intention to support the real estate sector without no official stimulus, as mentioned before as well. But that hinted the belief that iron ore shipments should come gradually over the next few months and grow faster, especially during the second half of the year. So this, together with an expectation that China will also start importing coal from Australia, which due to higher prices, I don't think it's going to have that much big effect. But the market by mid-March, so Shiriki 1 is gone out of the way, and 5th of March has passed, and by mid-March, the market translates all of this news and shares the belief that the markers, maybe they did not seem that bad after, inflation is correcting, unemployment is under control. There was not much of a global crisis as depicted in the previous months. And then the paper started moving upwards, all in contango. And people were afraid that, okay, what if the market suddenly jumps again at $20,000 and, I'm short of ships. And because of the previous uncertainty, and the below break-even levels, the owners were not there to give out vessels on period, right? Practically. So there were two things that happened. First of all, the big traders were left with short tonnage books. So up until now, you see people like paying $4,000 or $5,000 more above the spot values in order to get vessels into their books. So today I'm hearing fixtures being done at $18,000, $19,000 for Panamaxes, and the spot market is still at 14,000. Now, this is a hardcore evidence that there is potential in the market, and people are afraid of what's going to happen if the market's going to go back at $25,000. The second thing is that because of the uncertainty that we mentioned, the owners were a bit unsure on what to do with their vessels. And there were two things that mainly happened. One, there were people that giving periods on index deal basis, something that over the last 2-3 years we've seen a lot. But the index deals come with conversion clauses. So every time the people saw an uptick in the paper at levels that would be beneficial for them, then they would lock in 2 months, they would lock in 3 months, or like 100 days or 80 days. So this is something that will...
Okay, but Amalia, let me just get you on this one, okay? Because because I'm going to challenge you here a little bit, okay? Yes. Locking in a floating rate into a fixed rate is more about booking in the market. Is booking in an income that you think is acceptable. So it's actually showing perhaps a lack of, on behalf of, as far as the owners are concerned, a lack of confidence that the market's going to be stronger later in the year.
Agreed, fully agree. But imagine that owners that had fixed the vessels in December on index linked and they were earning $6,000, $5,000, $8,000, they will use this as a tool to hedge. So obviously each company has their own different strategies, right? So there are some companies that we know that no matter the market will fix always on period, which probably means that, in the good days when the rates were at $30,000, they were earning $12,000 and $13,000. There are other companies that like to play super spot. So again, no matter where the market is, I play super spot. There are
so companies like Diana, who are well known, for example, for
I didn't want to mention their name, but
okay,
yes,
I can. I'm the shipbroker, okay. I can get into trouble. Nobody cares, okay.
Yeah, but at the same time, I mean, and that's a strategy that we follow as well. You look at your fleet and you see at this market that you're cautiously optimistic, but marginally, and you say, okay, I have, let's say, 10 vessels. What about I do 1/3 spot, 1/3 short period, 1/3 long period? So depending on the strategy that you have, you might fix a vessel on index for 1 year. And then on when it starts making sense money-wise at 16, 17, 18,000, yes, you lock it in and you hedge, because
But yeah, I get that. But what does that say to you at the moment about the future strength of the market, and in particular terms, should we say asset values and so on? Is this a reflection of owners just trying to make sense of what is a very confusing market, or do you think that this is something that shows pessimism, perhaps, in the length of the strength of the market going forward?
I would say, I don't know if this word exists in English, precautionism.
Okay, we'll use it. It's okay.
Okay, we'll use it.
Precautionism. Okay, we've invented a new word today. That's good. Okay, good.
Basically, be precautious. Try and hedge your bets. Hedge your bets. Have
Okay.
some vessels bought. But the tricky thing about this index deals is that if you physically just rely on the paper, you will probably get premium compared to what a charter would give you at the same time for a 1 year period deal. So
Okay.
you would have about $1,500 as a premium.
Okay, so now your fleet, just to explain to everybody else, your fleet that you're controlling is Panamax, post-Panamax kind of area, and you're trading these ships, so that's your main focus as far as you're concerned. Some of these ships, okay, they're not the newest in the world, but they're not the oldest in the world, and it's a good mid-age and quality fleet. At what point do you start thinking, I should be selling now, or I should be buying now, or I should be thinking about the strategy of fleet renewal? And what are the factors behind it? Do you think, as far as your company strategy is concerned? I mean, I appreciate that you're on the coal face and you're fixing and like everything else every day, and you don't really have that much time to think about the longer term a lot of the time. But is there a time where you will say, okay, this makes sense to sell, or it's the right time to buy, or really I should do something? We should be thinking about doing something. When obviously it's not now, I guess, from what you're saying, but what factors do you think need to be considered when that either a sell or a buy situation takes place?
Well, I'll be very honest here.
Please.
We did try to sell one of our vessels.
Without telling me.
Well,
Telling
my husband is an S&P broker. So.
Okay, well, yeah, I hope you would tell him first. Exactly.
Yeah, but the point is that that was by the end of the summer last year, and I was hoping for a better Q4. I was like, okay, after the summer, the asset prices are still quite high. If you can get 20, 21 million, just literally just sell the vessel. We're talking about a post-Panamax built 2011. And the moment I decided that, I realized that I had already missed the train.
So it was your fault. You killed the market. Your decision to sell, you killed the market in that case.
No, I didn't actually, because I withdrew the vessel when I found out that I couldn't get 20, 21 million.
I think that was a very similar time, to be honest with you. I mean, there were lots of people who, especially in this part of the world, who at that time were saying, okay, the market is going ahead, asset prices are there. And there was a bit like that kind of, is it Roadrunner, where Wile E. Coyote is kind of running like hell after Roadrunner, and then suddenly he runs out on the edge of the cliff and realizes that there's nothing underneath him, and he falls like hell after keeping going. That was a bit like the asset values that went through from May, June, and July, and we were trying to do similar things at the time, and the asset prices kept on going even though the market was falling off and sentiment was going in the charter market. I think that I agree with you. There were many people that were hoping that was the way things were going. But looking forward again to this year, do you think that situation would happen again? Because at the moment, to me, the freight market and certainly the S&P market seems to be held up more or less by sentiment of what will happen rather than any strong evidence in the freight market, as you've already said.
Fully agree on that, to be honest. And that's why, as I said before, precautionism is something that I'm opting for, right? But at the same time, I don't want to lose the whole of flexibility, because we will see patches of volatility. And quite steep patches of volatility. So it will be good when you have spot vessels then enjoying the good rates. But at the same time, you shouldn't expect that, if the markets go back at $20,000 per day for, let's say, 2 weeks, you will have charterers saying, oh yes, I will take your vessel for 2 years at $18,000. It will not happen, right? So it will probably, what will happen, it will be like, yes, I can take your vessel for $20,000 or 3 to 5 months or 4 to 6 months. So covering on the long term at these high prices will be quite difficult, as I say. Now, with respect to the commodity, sorry, what was that?
No, I was just saying on that. So as soon, maybe the sentiment, the sentiment that you expect, or the sentiment is, whether it's in the charter market or the S&P market elsewhere, it's not particularly, okay, and I take into account your precautionism, but it's not particularly a solid base for shipping investment, is it?
Yeah, fully agree. And this is why, as mentioned before by Martin, it's quite difficult as a decision to place now a new building at $40 million and then expect the market to be at $19,000 for you to make money out of the asset, right?
If you can get delivery before your child starts to go to school or something.
Yeah.
I mean, I'm just trying to think in those kind of things.
So you have to be a super duper optimist, right, in order to do that. So just
just on that, talking of optimism, how much do you think that CII and so on is affecting things? I mean, obviously, my point of view just is that people are still confusing CII with EEXI. And CII is about the management of the ship and about how the ship operates. And as Oldendorf famously said, the most environmentally friendly ship is one going at full speed in ballast, which is no help to anybody, except perhaps to bunker suppliers. So in terms of CII, all the environmental issues, how much of that is a factor, do you think, in terms of why the prices are so high, say for new buildings or modern ships? Do you think that's a factor? Do you think do you think that charterers are looking for those more eco ships? And do you see more of that as a conversation taking place? Because I'm interested for the chartering side, long-term side, because this is where most of the focus have been. But it seems to be a lot of people are asking me about CII as an S&P broker more than they're asking our chartering guys in the office.
Exactly. I fully agree on that, actually. And I was having this conversation the other day, is that on the S&P side, you have more people asking what's your CII rating than on actual day-to-day chartering. So just to go back on the EEXI that you mentioned, believe that obviously the two different regulations and two different clauses, and charters have now accepted the EEXI BIMCO clause that it's in most CPs, right? At the same time, none of the charters accept the BIMCO CII clause, and they find it very difficult to actually agree on a CII clause, parties. Cargill has made a CII quite vague clause where charters do have not an obligation, but they have to use not even best endeavor, they have used endeavors to use the vessel the most efficient way they can in order to maintain a CII rating similar to the one that the vessel was delivered. But nobody will actually make a decision, chartering decision, basis on the CII value of the ship if the vessel is on period. So something that happened to us the other day is that we had a vessel that was, borderline D to E. So we told charterers, okay, the vessel is at this rating. can you please find a ship that is, going to be more efficient with respect to the CII rating? And obviously, as you said, they're not going to put the vessel in ballast in order to improve the rating, but they will try to find a trip that has limited congestion and, has actually more ballasting involved, which is quite difficult, especially in the Pacific, where congestion has been increasing a lot, and in East Coast South America. So when you have a long ballast of, let's say, 30, 35 days, and then you are stuck in port for a month, then obviously this kills the CII. So the intention is to have a communication between charterers and owners, but the reality is that I have not met any owner yet that has obliged charterers to do a specific trade in order to benefit the CII. And I have not seen any charterers actually saying, oh, your vessel is an E, I'm not going to use it at all. However, I have seen yesterday several vettings, specifically from Tata Steel, that do not accept vessels that have a GHG rating E, and they're contemplating on what to do with the CII rating. So this has started a discussion from the shippers and the receivers rather than on the chartering side.
Okay, look, Amalia, we should go and have coffee, I think, because we've got a lot to talk about here. And okay, I'll tell Yanni, don't worry. I'll tell him that I'm taking you out, and I'm not going to take his business away from him either. But just
you can work together. You can work together.
Okay, I'll do my best. Okay, now there's a lot more in here. First of all, I want to thank you very much for joining us at short notice. And obviously, it's apparent to me, and I'm sure to everybody else, that that your knowledge and passion behind the more, should we say, day-to-day and practical implications of what we're thinking about. I think there's a couple of things that I'd like to pick out for the benefit of all of us. First of all, how can I say it? There aren't that many options for buying and selling unless you've got a strategy at the moment. And there's not that many guides for many owners at the moment to see through the fog, because there's no real solutions in terms of a ship of the future. I think we can, whether it's secondhand, that's future proof one way or the other. And as Will said, I think, with his dual fuel and all of that stuff there, everything is restricted, and there is not one product at the moment, either in the new building market or even in the second-hand market, that will satisfy charterers, authorities, or whatever for the future of the ship. So actually, your options to buy are restricting your options to sell. And your options to sell will only be at a certain time where it makes enough sense in terms of the cash. The second thing that I think is that I take from that is that you are working in a market at the moment, in terms of the freight market in particular, which is driven by sentiment rather than by anything more, which is very powerful. And I believe it as a story. But behind the sentiment is these ideas of the story itself. And that story itself is still very confusing. And finally, which I think is very refreshing from our conversation too, is that no one knows. And I like the fact, I like the fact that you say precautionism is a very good word. And if it doesn't exist, I think we should trademark it. And once again, I'd like to thank you for joining me today at such short notice, and I hope I haven't been too harsh on you. And
thank you for having me.
And I really think we should go out for coffee, because there's a lot more to talk about here, but there's lots of more other people here that have many more things to say. So I think we should leave it to them. So thank you, Jagmeet.
Thank you.
That was absolutely amazing, Simon, Amalia. I think this is something very different we did this time, and thanks to both of you to make it so lively and so wonderful. And please don't go away anywhere. You can have coffee maybe after an hour or so. Right. Okay. And I'm sure the participants also enjoyed this very interesting way of presenting jointly. and touching upon the major concepts without statistics per se. So now I would request my other panelists to give an overview in about 4 to 5 minutes each. However, please allow me to introduce them first. Captain Rajiv Titharve. He's a shipping professional with over 3 decades of experience in freight operations, ship management, sale and purchase of ships, and marine insurance. Having started his maritime career ashore as a dry cargo broker in 1992, after sailing at sea for 16 years in various ascending capacities. He moved to commercial operations connected with container shipping in the feeder segment. This was succeeded by his experience in dry bulk segment as well as field of dredging in ship owner's office, where he was in charge of chartering and operations of bulk carriers. He's a well-known name in the dry bulk industry fraternity in Pacific. He's a fellow of the Institute of Chartered Shipbrokers as well as that of Nautical Institute. Thank you so much for joining us today, Rajiv. Then we have Mr. Rahul Kapoor. He is the global lead. I'm going to introduce all of them at one time so that later on they can speak one after the other, so there is no further break in the presentations. So Mr. Rahul Kapoor is the global lead shipping analyst, analytics and research at S&P Global Commodity Insights. Based in Singapore, he heads an integrated shipping analytics research and data science teams. As he was saying that how important data is, that sort of billions of dollars are involved in it and transactions. As a business lead, he is responsible for growth of analytics products in cargo and vessel intelligence and freight market analytics. A subject matter expert as a subject matter expert in the maritime industry and financial markets. Rahul is a thought leader with proven credentials in market analysis, forecasting, shipping economics, and commodity market developments. He's a regular speaker at major conferences and client events globally, and is frequently interviewed by both print and visual media. I have seen him a number of times on Bloomberg. Most recently, he was at Bloomberg Intelligence and earlier headed Drury Financial Research Services Limited. He has also worked as a senior equities analyst at RS Plato Markets and Nomura. Welcome to the panel, Rahul. After graduating from Norwegian School of Management in 1986 as a Master of General Business, Mr. Morten Ingebretsen worked for Will Wilhelmsen in Oslo for 3 years before joining Pacific Basin in 1989, spending 8 years in Hong Kong and 2 years in Malaysia before relocating to Europe, and is today Director of Asset Management with responsibility for Pacific Basin's sale and purchase activities, as well as overseeing much of company's shipping research. Great to have you with us today, Morten. Captain Narasimhan has more than 30 years of experience in shipping, of which 14 were on board the ship. Starting his career with bulk carriers, he sailed on product tankers, ending his sailing with chemical tankers. Thereafter, he joined jobs ashore. He was earlier CEO of APJ Shipping in India, is now COO with KC Maritime Hong Kong. He is a fellow of the Institute of Chartered Shipbrokers and associate fellow of the Nautical Institute. Narasimhan is a member of the executive committee of the Hong Kong branch of the Institute of Chartered Shipbrokers. Many thanks for being here with us, Narasimhan. Thank you so very much. Now, can we start with Rajiv, followed by Rahul and Morten, and then Narasimhan? Thank you.
Hello, guys. Good afternoon, everybody. I hope all of you can hear me well. If you do, Jagmeet, just give me a thumbs up. Okay, that's it. Good. Thank you. Well, so what we are discussing today is asset values in 2023 and beyond, is the heading that the Institute had decided to have this program on. Fantastic presentation already from Simon, from Will and Amelia and Simon's Ward, and then Martin as well. Regrettably, I couldn't hear a lot of what Martin was saying, unfortunately, for whatever reasons, but I'm sure I'm the loser here. He must have said some very entertaining things and good things. So asset values, to me, basically, what are we looking at opportunities, or we are looking at of acquisitions, or selling your ships out, or you're looking at financing opportunities? In terms of that, you're looking at asset values. There are several ways of looking at this single word, asset value 2023. So my take on this is that first and foremost, I don't see any indication of new building prices coming down at the moment. At least I don't see it in the last 6 months' time. I haven't seen it maybe in 9 months' time, and I don't see it now. My recent discussions with various yards clearly tells me that nobody has any slots available before probably first quarter of 2026, and particularly for bulk carriers. And I have been a bulk carrier man all along, except for a few years of container trade. So I will only talk about my experience in bulk carrier market. So I don't see any slots available anywhere in the yards. And that means that the yards will keep on maintaining their levels of the prices that they are asking for whatever reasons, whether the steel prices have gone up in Japan, or the labor cost has gone up in China, or there is no slot available in Korea because they're all busy making LNG carriers, whatever may be the reason. The prices, I don't see them coming down at all. That is on the direct acquisition. The other thing is that there is also, it's a paradox, because at the same time, nobody is ready to order either. Because you don't want to order because you don't know how things are going to pan out. This alternate fuel has taken everybody's, wind out of their sails, because no one knows how things are going to unfold. In one of the recent lunches, I had asked this question from somebody quite senior at ICS, that will CII MEPC 80 in the month of June really produce something on CII, or will the can get kicked down the road further? And there is no answers to that, except for the fact that he said that CII is a reality and it is here to stay. Well, love it or hate it, it is going to be around in one form or the other, whether Oldendorf hates it or a Cargill likes it. It doesn't matter. It's going to be around here. So CII is also affecting the asset values. That is at least the view that I hold. Because of course, the base of that is that I'm assuming that CII is going to be around, and that is why I think it is connected to the asset value. If you have a ship which is currently in A, it will take some time for that ship to go down into D or E. So obviously, if comparing apple to apple, if I'm offered a ship which has got a CII rating of A, and I'm offered a ship which has got a CII rating of C, as of now, it can always change. My natural inclination would be to go and acquire a ship which has a CII rating of A. And I think to that extent, the asset value will matter, because your ships will be valued higher if your CII rating is better, irrespective of how the CII is going to completely pan out. That I'm absolutely convinced of. Then the question comes about the alternate fuel, whether what impact it will have on the asset values. Now, most of you here, I'm pretty sure, are well versed with the fact that the leading classification societies right now, without naming them, I can tell you, none of them are saying that you should be going for any kind of alternate fuels. The clear consensus is stick with conventional fuels, but try to make your ship as efficient as possible so that your CII ratings remain low, your EEXI remains well inside, both the things together. So obviously, if you need to do that, if you're going to definitely do that, you will be looking at yards which are in first tier yards, because those kind of designs, the hull lines, etc., that you expect, you would definitely have to expect it from a yard where it can come in nicely, so that your expectation of getting an efficient ship is filled up. As far as the financing side of things is concerned, I am not really going to comment much, save for because of the fact that the organization that I work for has never sort of considered their acquisition strategy with respect to a financing available. So I am not very clear on that side of things, but I would definitely say that yes, loan to value is a critical thing, and people who need, the interest rates have gone up. It was much cheaper to get loans before. Now it is difficult. But then at the same time, I'm also aware of the fact that a lot of boutique financing shops, which were really outside the reach of many owners, are now becoming very competitive because they can compete with the banks. The banks are required to charge you higher interest rates. So going forward, as I see right now, my view is that the asset values will either stay flat as we saw last year, or improve further. They will gain. I don't think that we are looking at any deterioration in asset value. That's my view. Thank you.
Thank you very much, Rajiv. Rahul?
Thank you. Thank you, Jagmeet, and great to be here. Thanks for the opportunity and awesome presentations earlier. So I'll talk about a few anecdotal points, right? We've been talking about assets, and I was just reading today, Singapore rents are up 100%. I'm not sure what's happening in Hong Kong. In India, the rents are up 100% in Bangalore, in the US, Europe as well, right? So we are in a very inflationary environment. And I'll talk more macro and try and tie this up, because back in 2008, and we did discuss this, I was at Lehman Brothers when it went bankrupt, right? And we just had a collapse of SVB, Silicon Valley Bank in the US, two more major banks, and Credit Suisse, which was a defined systematic investment bank, right? Part of the 30 banks globally, which are defined as very, very important for the global financial markets, and which could trigger a global financial crisis if they were to go under. So we are in a very different environment compared to where we were 2008 and 9. So I think just to add a few things here, particularly with respect to what we are seeing on the economy side of it, right? Because in the end, shipping is a derived demand. So narrative is certainly more complicated with what happened recently in the last month and a half. We're not seeing that in the shipping market, but just on the economy side, there is a real economy and then there's a financial economy. The real economy has been very resilient despite rising rates, right? I think over the last 2.5, 3 years, the pace of activity since we started coming out of COVID has remained very robust. And this is particularly on the services sector. Like I said, labor markets are very strong. There's strong wage growth. And that remains a sticking point for the global central banks because inflation remains elevated. And if you go back, shipping always benefits from inflation. Inflationary environment leads to better freight rates, which we are seeing right now, asset values and so on. It's the deflation, which is negative for shipping markets, right? If I know that the rates are going to go down, if I know the asset values are going to go down, if I go into that environment, I start pushing back. And that happens across, that's economic 101, right? So right now for the foreseeable future, we are expecting the inflation to be sticky, right? Despite the rising rates, and we expect the rising rates to continue as well. So what we are saying is the rates would be, and talking about interest rates, certainly will be higher for longer. So that means, again, that does benefit shipping in that sense because not everybody can get in. That does create a barrier to entry. So this is on the economic front, what we are seeing right now, right? Coming specifically to what our view is on shipping is, like I said, it's a derived demand. It does need global economic growth. And in case of dry bulk, it's the Chinese domestic growth. And I would concur here with Will as well. Right now on the economic front, the 2023 numbers are going to be okay. We had significant improvements already in 2021 and 22. So 2023 is likely to see a lot of headwinds. We've been disappointed, and we've been saying that do not bank too much on the Chinese reopening. I think we've been disappointed with that. I would say it has been anemic in terms of the bulk commodity demand, and the real estate sector, the key driver, remains weak. We're not expecting any gung-ho in terms of major stimulus, which came about, let's say, 2008 and 9, again in 2014 and so. So we're not expecting any of that stimulus to flow into fixed asset investments or real estate. There might be some of these on the margins, and that could support in the second half of the year. And the reopening will primarily drive the services sector and could be industrial production. But this is all happening before the global economy, for that matter, hasn't even gone into recession. You see the US numbers, and there's always a lag in Asia. So we are expecting US as well as Europe to go into recession this year. That's our S&P Global forecast. So we would expect that to have an impact on China as well. So that's the key in terms of the demand side of it. The biggest risk for us has been for quite some time now is lack of any significant recovery in Chinese real estate and fixed asset investments. I think that has peaked already. So it continues to be an elephant in the room that will continue to keep a lid on demand. But having said that, we are not in 2008 and 9. The things are very, very different in terms of supply side. If we were going into 7-8% of supply side growth, which we saw for years, the market would have been a very different market, right? Asset values as well as the future FFAs and everything, whatever is signaling to you what's happening on the supply side. Whether it's 1%, 2%, 2.5%, 3%, it might have an impact on the short-term rates. But what we are seeing with this multi-decade lows in new building contracts, and that's driven again by new buildings, what's happening with decarbonization, what's also happening with people's, or I would say everyone's expectation of long-term dry bulk demand growth, right? So that's also driving this low new building contracts. So supply side realization is what is essentially driving earnings, right? So that is providing support as well. So overall, what our expectation is that the positive changes in supply side will drive profitability. Rates will stay profitable. Few quarters in there, like we see seasonally weaker periods, you might go down. But overall, this decade is going to be much, much stronger for dry bulk than what we saw in the last 10 years. So much better earnings, much better asset values, and overall a positive outlook for dry bulk over the next 2 to 3 years at least, and overall for this particular decade as well. And then we'll go into some of these questions as well. Thanks, Tiffany.
Thanks, Rahul. Thank you so much. Okay, can I invite Martin, please?
Yes, thank you, Jagmeet. I mean, first of all, thank you for hosting this webinar and for allowing me to join it. As the topic is asset values, or if you like, vessel prices, perhaps it's useful to remind ourselves how remarkable it is that assets that are worth tens of millions of dollars can be traded more or less as vegetable in a country market. I think those of us who deal with S&P of ships on a regular basis are used to this, but from an outside perspective, this must look weird and incredibly risky. I mean, very often ships are sold without the buyer having been on board before signing a very simple sale and purchase contract. And despite this, the sale and purchase of these multi-million-dollar assets works incredibly well and efficient, both for the buyer and the seller, despite neither party in most cases having had any prior business relationship, and in many cases, apart from crew change, not even meeting when millions of dollars change hand against ownership of vessels. So of course, trust and experience are key ingredients for making this happen. It may well be that in the future, we're moving towards ship values and S&P interactions becoming more commoditized and traded with much less human interaction. But I think, I mean, my view is that if to the extent that is happening, I think we have a long runway with the current system. Of course, our use of sort of digital computers, technology, all of that sort of thing has increased massively. And I think none of us can imagine working without this, but there is a human element still at either side of an S&P transaction, and also with a human intermediary, the broker, i.e. Simon in this case, in between to help both sides reach the equilibrium that is the price of an asset. And this is an efficient process, and it reduces risk of something going wrong. Over to prices, sort of in just a little bit of theory. I think that apart from sort of the vessel specific attributes like age, size, physical condition, yard, design, that sort of thing, you have basically three elements that influence the price of an asset. One is earnings, which is, if you like, supply and demand, the freight market. The second is expectation, so your view on the future. And the third one is replacement cost, which is the new building side. And I think outside of shipping and looking back over multiple decades, our industry would probably be regarded as something that could be taken pretty much for granted, in the sense that access to maritime transportation has always been available, and most of the time at a cheap cost. And when you've had periods of elevated freight rates and vessel prices, these have tended to be short-lasting variations to that norm, after which ship owners would always get carried away and order too many ships that end up delivering a few years later, typically when the market is past its peak, and thereby depress freight rates and vessel prices. So this meant that a supply shortage would take care of itself through new ordering, fueled by high vessel earnings and expensive second-hand prices, making new buildings look more attractive. And what has been remarkable over the last, I would say, 9 years, since around 2014, when we had the last significant ordering boom, is that contracting of new buildings appear to have become more divorced from market optimism. And what I mean is, and if we look back at ordering activity over more than 25 years, when we have sort of reasonably reliable data, and measuring this over the last sort of last 12 months as a percentage of the fleet, the only time the ordering as it is now over the last 12 months was lower was in 2017, which, as you all know, was following the all-time low market condition of 2016. And the bullish periods of 2021 and 22 for dry bulk should, under normal circumstances, have led to a massive ordering of new buildings, but it did not. And of course, it's tempting to look at this as ship owners having finally learned the lesson of excessive ordering. But I think a better explanation can be found in the uncertainty that we discussed associated with carbon emission reductions, and which fuel, vessel design, engines, all of that sort of thing will be the right ones for the future, technically as well as commercially. We've always had risks associated with shipping cycle timing when you order a ship or when you buy a ship. That was always the case, but we now also have the additional risk associated with choosing a vessel and a propulsion system that will be fit for service over the next 25 years, i.e. until 2050 and beyond. And this represents a significant new element of risk that as shipping stumbles towards carbon neutrality in the decades ahead. And this basically, from my point of view, sets the scene for a dry bulk supply side that is pretty much unique in terms of A, a record low order book, B, appetite for new buildings being held back by uncertainty over the new designs, future maritime emission requirements, which we all know is going to be stricter, not easier to deal with. And C, emission rules that will increasingly limit speed, vessel speed for the existing fleet and thereby reduce supply. So beyond a favorable supply side that helps to elevate earnings, which is the first of our three factors that I mentioned affecting price, this also supports future expectation, the second factor, when knowing that appetite for new buildings is held back. And finally, the third factor, replacement cost inflation, is provided through new emission-friendly designs, not just being more expensive to build, but also more expensive to operate compared to designs of the past based on burning fuel oil. It's of course tempting to dismiss this as fruitless arguments along the lines of this time is different, which is so often proved wrong. But I think we can all see that the pressure to decarbonize shipping is representing something that is genuinely different from the past, and it's unlikely to resolve quickly. It's not just the dry bulk fleet that is under pressure, but also the rest of the shipping sectors. So doing so within a sort of a reasonable time frame means that this is going to take time. And I'm not suggesting here that the down cycles are disappearing or cyclicality in shipping is disappearing. That will be provided by demand moving up and down as it always has. But I think that we have the ingredients for a higher floor than what we've had in the past. I think also on this, as a side comment, shipping is a very physical business, a very old-fashioned business, and if you look back, certainly over my time in shipping, we were seen as an anachronism or sort of old-fashioned, not really sort of an unexciting part of business or transportation that was always there. I think what has happened in the last few years, particularly during COVID, but also as a result of the Russian-Ukraine war, is that we can no longer be taken for granted. And I think all of these physical things, including access to food, access to electricity, to energy, has taken on a new meaning. That means that shipping is more in the forefront, and people are not, people who deal with this on a daily basis, whether you're governments or you're running a factory or whatever, you can't take shipping for granted anymore. And I think this is also helping us in the sense that we have a sort of a higher profile and we become more important than what we've been in the past. So on that note, I'm not going to say anything about China or anything else because we have the discussion going on. So I will stop here and let the next person take the baton.
Yeah, I think before I ask Narasimhan, I have a very quick question for you, Martin and Rajiv, and Narasimhan can also join in. If you had an opportunity from a very good Japanese shipyard for, say, Ultramax vessels, and there would be berths, say, delivery 2025 end, would you place an order today with today's technology, Martin, and then Rajiv, then Narasimhan?
Well, I think for us, it's a relatively easy question to answer. We've gone out publicly saying that we are not going to order more ships with conventional main engines. We might take them for charter for a period, but we are certainly afraid of being left with an asset that will become a dinosaur in the decades ahead. And from that point of view, I think the answer would be no. As Martin mentioned, although many of you couldn't hear it, we are looking at alternative designs, alternative propulsion systems. We do find the new building prices are getting very expensive, but this is something that we are looking sort of at in some detail, and hopefully that will materialize into some action on our part in the next sort of year or so, I would say.
Yeah, thanks, Rajiv.
Well, I mean, my personal view is yes. If I can get a Japanese yard to give me a ship which is really fuel efficient, I know they are at the moment rating themselves very high. Ultras, they are looking at something like $36 million, which is a big number. But if the question, what you are asking, if I get you correctly, Jagmeet, if the question you are asking is that would you go for a conventional fuel ship or would you look at for a ship with an alternate fuel? My answer today to you would be conventional. I'm not yet supporter of alternate fuel. I do not really think that there are any financially feasible options out there to support any of the alternate fuels. But that's a separate discussion altogether. The short answer is conventional fuel ships, as long as they are efficient and stay within the lower band of CII as well as a good EEXI number.
Thanks, Rajiv. Narasimhan, what do you think?
Yeah, so good evening and thank you for having me here, Jagmeet. Coming at the end of a series of stellar panelists and presentations, not much I can add. Coming to your first question, whether I would recommend, I personally would not recommend that. I would, a Japanese built vessel, 2025 M25, today is about 36-37 million, and slots nearly are not available. What Martin had mentioned earlier, that's going to have a break even of $19,000 over the next 20 years, if you're looking at 20 years life. So I would not be, I would not be recommending something like that. I would not be that optimistic of the market, because there is high volatility in the market. There are definitely factors which are supporting dry bulk, no doubt about it. But then to invest again in a conventional vessel when there is so much of R&D happening there in new technologies, and we do not know how the regulations are going to change with IMO, because IMO has not laid a roadmap completely till for the next 25 years. It's in stages now. So what's going to be the next step and how it's going to impact, it's still not clear. Therefore, I would not, this would be my position.
All right, thank you. Would you like to add anything more to whatever has been said?
Yeah, a few points which I would like to add. One is that, okay, we are in a scenario definitely looking at asset values. Asset values are definitely being affected by the market. We had seen a pretty strong market towards the end of December, means we were able to look at reasonable prices for the ships, not as much as the May, June, but definitely whoever had operated or fixed vessels in May, June would have definitely realized by way of charter hire earnings. And December was a good time. And after that, the asset value kept dropping when the charter rates fell down on spot rate to $5,000, $6,000. Definitely the asset values had gone down. But again, with the rally at the end of February and March, again, it has come back. So it's in healthy levels now. So definitely the asset values are open to the market. There is a fluctuation and there is high volatility in the market. But whether that would really make a compelling case to buy, I doubt, because what has happened is practically all the owners, they had enough time to build cash on their books, and therefore they would not be in an urgency to sell unless it's a decision to sell for the purpose of fleet renewal, or existing orders have been there, and or for the purpose of replacing one with the other, which will be a different kind of strategy. But I don't think the owners will be in an urgency to sell. Regarding the impact of EEXI, definitely the engine power limitation is going to slow down ships. But then we also see that what is the actual impact we need to see, because I have seen ships which are built from the same yard, but the engine capacity has been different. Therefore, one vessel is impacted by the ESL, same yard, same year, everything same. But the other is not impacted that much, because there are a lot of variables which are there, which will also impact on the EEXI aspect. On the CII aspect, definitely it's still work in progress. We still do not know what's going to be the factor. Yes, CII is here to stay, because I don't see any way that CII will be rolled back. But what could be the changes or the improvements would be the correction factors. We have had already the first set of correction factors which are coming. But the ones which people have been talking about is, the waiting time, idle time in port, and then ballast legs, all those things. I'm sure that it's been raised enough that IMO should be looking at it. So we can expect some kind of correction factors coming in later, which should give some kind of a level playing field. Even when Rajiv was there, the person from ICS was mentioning there are two sister ships of 18 ships of similar build. One of them is in A and another is in E. So how do we explain it? What's wrong with the ship other than the way the ship was operated? Still, there is no buy-in from the charterers to support the owners with respect to maintaining the CII. The BIMCO clause is not accepted. No charterer is ready to accept, even if the vessel is delivered with A, to say that I will redeliver the vessel with C. The charterers don't want to have any kind of a commitment on what kind of rating they would maintain on the ship. Therefore, I think it's a work in progress. And if suppose an owner wants to sell a ship, and if it's just two ships which are very similar, I'm talking of a hypothetical scenario. One has got an A and another has got an E. And if the buyer is going to discount, you'd rather sell a ship with the A than an E. So I think that, and then again, the CII doesn't have any penalty. So what happens when the CII ratings are not met? What kind of improvement plan is to be there? There have been, I've heard some owners talking about extensions from class and continue to operate and present a plan. So if somebody is going to operate the vessel on spot market, they have a better control over the way the vessel is operated, because they have the direct choice of where the vessel to be fixed. So we still have time to go for this year to see how this CII is going to pan out. Yeah, I think I've added whatever I could. Yeah.
Yeah, thank you. Thank you so much, Narasimhan. And I think I must thank Amelia, Martin, Will, Simon, Rajiv, and Rahul, Martin, and of course you, Narasimhan, for your excellent input. Now, very quickly, I would like to go to the Q&A box. There are a couple of questions. I'll just take the first one before I shoot my own questions. So it says, hi Jagmeet, I joined online from India as I don't want to miss a great event. I have a quick question to Will. He mentioned his assumption per base case. I want to know what is low case and what factors might derail optimism for dry bulk sector. I think Will is not very optimistic about dry bulk sector, but anyway, I will still ask him this question. How worse can it be?
Thank you, Jagmeet. I think the funny thing is, we see ourselves quite optimistic on the trade for dry bulk this year. So despite all the issues I mentioned, actually overall we've got trade growth of just under 3% this year for trade. The issue we have is the fact that is building on a situation where you've got the increased inefficiencies and you've got the containerized cargoes moving back into container ships. and particularly this time of year is the time of year for renewing those contracts, the long annual contracts with container ships lines for the large sort of low value dry bulk goods. So it's something that is still yet to really work through. So yeah, I guess I'm underlying why our base case is actually quite weak. And if I want to underline that, I would say that with our modelling, we can see we can quantify the impact of these inefficiencies, and it's about the same size as the iron ore trade from Australia to China. Okay, that is the scale that we think these inefficiencies have had on the market, and we think they're all coming off now. So that's our base case. Now, low case, certainly if we don't have dry bulk trade growth of 3%, and there's many factors that we've talked through, and you know we actually have China steel production increasing by 1.5% this year in our base case, but it seems to be consensus is moving more towards zero. So it's a situation where you are looking at, in a low case, employment rates dropping down to 80% below, maybe, which is looking at very, very weak markets. That's our view. So, you know, it's an interesting one. It's as much as we're negative, we see more negatives, but there's also always the unknowns, and China could also be a source of an unknown positive at some stage as well. So we have to bear in mind that we have a high case scenario in our report where we build a case that Capesize earnings would be $30,000 a day at the end of this year. So you know, there is still that potential. So it's quite a range. It's quite uncertain at the moment, which is quite awkward to present. But some downside.
Thanks. Yeah, just very quickly, Will, I just want to have that clarity in my mind. So all your base case, low case, everything takes into account the reduction in iron ore imports in China. Again, the scrap factor and using it in basic oxygen and the electric arc furnaces. It includes that, right? Takes into account.
Yes, absolutely. Yes. We don't have it's not a complicated black box type model. It's very open, and the calculations are almost like a big string of back of the envelope calculations. So how much electric arc furnace share, how much steel is used is all there. It's all taken into account.
Okay. All right. Now I have a question on ship finance from one of the participants here. So this is again open to all the panelists, whosoever would like to take on. Let's say starting with Morten, and somebody else can join in. How will a ship owner secure bank financing if there is no long-term charter and therefore no real projection for returns or project viability, coupled with uncertainty about CII, EEXI, alternative fuels, etc.? The decision to buy new buildings is very muddy. It's more of a comment, but just coming to the first question, how will a ship owner secure bank financing? And this is where I would like Rahul also to come in and talk a bit more about the Poseidon Principle. What is the present situation, if you can?
Yeah, no, you asked me to start off here. As a public company with every time we report our results, we end up paying net cash, so we're in a sort of a difficult, an easy position in that sense. But obviously, we have banks. We want to maintain a relationship with them. It's a long-term business, so we're not. We are mindful of financing and also keeping the banks on the side. As long as I've been in shipping, there's always been questions of shortage of finance, shortage of money, that sort of thing. It always, if the market is there, it always seems to go away. It finds its way, money finds its way into shipping if shipping is attractive enough. So I'm not really a big, I don't really sort of put too much value on whether shipping banks are in the market for giving out loans or not. I think actually private equity and that sort of, and fundraising in that sense is probably more important for shipping, and money coming into shipping, not really understanding shipping, but perhaps seeing it as an alternative for getting sort of 0.5% on your bank account. In that sense, I think the higher interest rates are helpful because it raises the bar. So when you look at shipping, you're not comparing against 0.5%. You're comparing against sort of 3 or 4%, something like that. So I think it's helpful. But in general, I'm not seeing access to finance being a huge mover, except perhaps in Japan, where the absence of long-term charters have held back Japanese owners building and contracting ships at yards, which is something that we see on a sort of relatively recently that has an effect. But that obviously is more to do with long-term chartering than access to debt financing.
Right. Anybody on the finance part? Poseidon principles? Yeah. Yes.
Yeah, I think just few things to add here, right? That's what I'm trying to make a distinction between 2008-9, when we had a global financial crisis, and what we have now. So I think, I'm not sure how many noticed, but this company called Himalaya Shipping just upsized its IPO from $10 million, raised $45 million. It's ordered 12, I think 2 on water and 10 more LNG dual fuel vessels, right? So the fact is, if you have some of those vessels which are there and which is available for green financing, which markets like, banks like, and all fits into this decarbonization theme, the money is available, right? And that's what we're seeing on the other shipping segments as well, whereas the conventional fuel, and that's also driving this low order book. You see that on the tankers as well. But you also realize that one good year, you make all the money which you haven't in the last 10 years as well, right? Which we've seen that started with containers, dry bulk had it for 2 years, and tankers are going through that as well. So the bankers understand that, and they do understand shipping is a cyclical business. So for a good owner, top tier, we don't see any financing problems, right? And just to add a point, there also is this decarbonization and conventional fuels versus the debate on the non-conventional and the low, what we call the cleaner fuels. You're not seeing that on the order book. I think there's a lot of talk regarding that, but the fact is, on the order book, you still have mostly, and even today, the dual fuel LNG ships are not burning LNG. They're burning VLSFO because LNG is costlier, right? So we are seeing a lot of that as well, but I'm not sure how many of that will actually come into place. I think Rajiv will agree with me there, and that's what I think. There is a lot of talk of that, and I did mention it earlier. I was in Houston for CERAWeek. That's one of our Energy of the Davos kind of a conference. There is a lot of focus on energy transition, rightly so. But in the short term, and I would agree with Rajiv when he said he'll buy if he gets 2025 Japanese ship offer, because for the next 5-10 years, we'll make multiples of that, because not everyone is going to order. As in, mostly the order book will stay very, very low. Yeah. So that's what I wanted to add, Jagmeet.
Yeah, Rajiv?
Yeah, I mean, we, like everybody else around here, we've been looking at alternate fuels for quite some time, and we've gone quite deeply into it. I as a commercial man, as a chartering man or ops man or sale and purchase man, whatever you want to call me, in any way, I don't see any possibility of anything happening. Just to give you one short thing, that the company that I work for, we could have been the pioneers of the first LNG fueled ships, bulk carriers of ultra max size. No one else has ever offered. We worked on it for 3.5 years long. And we just couldn't get it. Eventually the yard said that, okay, your 4 orders are fine, but I need 8 orders minimum to make sense. Otherwise, I can't build a ship. And the yard could not find a buyer for the balance 4 ships. So we were hanging around with our 3.5 years of time and energy and expense, waiting for someone else to bite the bullet, but no one else did. And for good reason. At that particular time, LNG bunkering was practically impossible. But we were convinced that, yes, Shell is there, and Shell is doing this, and Shell is doing that in Singapore and Malta, and blah, 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 and we will definitely get it. Shell was even agreed to give us LNG bunkers in the entire European range, ARAG range, anywhere you want, just 3 days notice. We were ready to go. But no one else bought that story. You have to still pay a premium of $8 million over a conventional ship. And what happened? Times changed, and the LNG prices overshot the market. And now people who have dual fuel ships, I know particularly of owners who are crying right now, because even when they're not using LNG, the boil of gas, I'm sure as an engineer, you will understand what I'm talking about. The boil of gas is bleeding them just because having that LNG thing. So till such time that there is some certainty on the alternate fuel, hydrogen is out, ammonia cannot be done. Methanol, big, okay, it's all gray. Tomorrow it will become green. For Christ's sake, Maersk has not been able to source more than 19 ships worth of methanol for their ships. You're going to get methanol? So, yeah, okay, the goal is good. You want to go ahead. What you got in target is good, but can you reach it? And if you cannot, then in the interim, if you have to take a decision. That's why I do not disagree with Narasimhan. I'm not talking about earning $19,000 a day for the next 20 years for a $36 million Ultramax. That's a separate question altogether. Who knows? We could have a Darya Brahma with $50,000 a day for 2 years charter. And the whole thing will be quits. That $19,000 argument may not be there. What I'm saying is that in the current circumstances, for the next 5 years, I do not see a feasible alternate fuel. And therefore, if I'm being asked, should I be buying this? Of course, the best thing is don't buy anything. Sit tight if something happens. But if you are forced to buy, then yes, I would buy a conventional fuel over any alternate so-called ready ships. I'm not a big fan of ready ships.
I'll just add one point here before everyone. So again, there's biofuels, the green methanol, ammonia, all of this, right? The first access for that would be container ships, right? I think your fossil fuel or commodity shippers come way, way behind. These guys have access to that. So they will use the Walmarts to pay for that biofuel or green methanol, charge them 3 times the container freight rate, and that still counts as dollar per unit, much, much lower for these vessels and for this supply chain than for commodity shipping.
If I can just add a little bit, sorry,
Yeah.
Jagmeet. First of all, I just wanted to correct the assumption of the question itself. In this part of the world, anyway, and I think Morten would back me up on this. Finance is not dependent on mortgage finance anyway is not dependent on having a charter attached. It's not dependent on anything like that. It's dependent on the creditworthiness and the relationship with the bank. And these banks will know their customers, and they know very much, as Rahul said, the cyclical nature of shipping as itself. The banks will and are supporting fairly low gearing, 50, 60, 65% on this basis, on the basis that these owners know what they are doing. Most of those owners will specifically not fix out on a long-term period charter, simply because they understand what the dry bulk market does, and they have to take the losses when the losses come, and they take the profits when the profits come. And that is the only way of working a cyclical and a counter-cyclical market. So I think the finance is going to be based more on the creditworthiness and the cash reserves of buyers and their strategy going forward than anything else, even concerning the very interesting discussions on fuels or otherwise. As far as the fuels are concerned, whilst there are laudably so more ESG factors coming into ship finance in various places, I think that we should concentrate on all of the ESG and not just the E, which means social and governance too. And social and governance also, as far as the Poseidon's principles are concerned, contain things like diversity in the workplace, procedures in place, and so on and so forth. So it's how the company and the management company itself is run will be as important by what boxes it can tick in the green area too. That's my point of view.
Yeah. No, Simon, I 100% agree with you. I very strongly feel about this ESG part. I think if we had this little bit earlier, our seafarers possibly may not have suffered what they went through during the COVID period, because the social part also includes the employees in the company. So I think that's very good. Now, this is now for the guys who are in chartering and in the commercial shipping. You know, from Will's presentation, we saw that the demand volumes were not so great, but still we did see in the last 1.5 to 2 years, the freight rates were going up. I think that shift from short haul to long haul because of the war, you had the coal coming into Europe and then the grain trading patterns changing. So my question is that if Putin and Zelensky decided to end the war tomorrow. So what do you think could be impact on the dry bulk market? If suddenly the war came to an end, then what do you think could be an impact on the ton miles?
I think
Yes,
that,
Narasimhan.
yeah, if I can add, I think there will be a huge impact on the smaller size vessels, especially because there's going to be huge reconstruction, which is going to happen in Ukraine. And therefore, I would expect that the smaller size vessels, yeah, the ton mile impact, we do not know where the sourcing and the movement is going to be. But I would guess that the volume itself will be quite a bit, that it would offset any reduction in ton mile. Today, what had happened is there has been changes in ton miles because of the cargo movements, and then the same cargo which goes out of Russia to various countries, and therefore they are absorbing a lot of tonnage there. But the volume which is going to be absorbed from this reconstruction of Ukraine is going to be quite big.
Okay. Anybody else would like to?
I just
to-
wanted to make one point, Jagmeet, and that also is for somebody like Will as well as for Rahul. I find a very strange phenomena coming in the dry bulk market analysis in the last 2-3 years. If you look at the SSYs and the Clarksons and MSIs and all, everyone talks about capes. You will hardly find, if you read an analysis, it will be 3/4 of a page on Cape and 2 byline on Panamax and 1 line on Supramax. Why this has happened, I'm really not clear. I've asked so many research people. And again, the question that you are asking about Black Sea trade, again, goes back to the same thing. We are talking about handy trade. I don't think Capes are going to get affected. I don't think the Supras or Ultras are going to, or Panamaxes are going to get affected, or maybe not to that extent. But this is something that I have not understood. No research broker tells me why they only talk about Capes all the time. But yes, Narasimhan is 100% right. If Black Sea war stops, the handy market will get a lift for sure. You may say that there'll be a push-up effect, that if the handies are getting better, then the Supras will get better, and then Panamaxes will get better. But I still don't see how Capes will get affected. I really don't see. And the other thing that I don't understand about this market mechanism is that China, we are talking all the time, and Will knows and his company knows, MSI is very strong in all kinds of analysis. We are talking about just one commodity, iron ore. And I find it very difficult. I remember several years ago, Nobusa, a very famous personality you all know, he took a helicopter and he took a ride in Australia, and he went all around Australia, and he took an aerial picture of that. On the basis of that, he gambled against that, and he was a winner in that gamble because he knew how much cargo volume to expect. Why is it so difficult for analysts to understand what is going on in the iron ore market? Why does Cape go down to $2,000 level and then comes back to 12,000? I really don't understand. I mean, after 32 years in shipping, in commercial shipping, I really don't understand. But yes, handies will definitely be affected. I'm pretty sure of that. And maybe to some extent, ultras, if this war comes to an end. But I don't think this is going to make a difference on the Cape market. And I am almost convinced that it will not make any difference on the Panamax or Kamsarmax market, as you call it.
China starts exporting
So
mostly.
we have two analysts over here. We got Will and Rahul. So I'm going to leave this question to them to answer. So why is it so difficult, number one, regarding Capes, and number two, why do you always focus on Capes?
Go ahead, Will. I'll come after that.
Okay. Yes, I feel I have to answer that question. Yes, thank you, Rajiv. It's an incredibly good point. I think
sorry about that, Will, but I had to ask this. I couldn't let this opportunity go. I'm sorry about that.
I mean, clearly, the sort of obvious answer is that the Cape-sized market, the iron ore market, has driven the dry bulk trade since the early 2000s. It's been the biggest driver, and I think it's a very important part to explain even now why the market's changing. And I hope I tried to look at that in my presentation about the changing structure of trade. And so it really is, as you're right, a transition. Really, and this is MSI's view, is that capes aren't really going to drive the market anymore. And it is the minor bulks trades, and it is the smaller vessels, it's geared vessels. But we also have to, we do have to try and analyze where a cape's going to fit into this. How much coal trade can cape sizes take? Bauxite trade, obviously, and other trades that will then cascade down to the smaller sectors. So it's interesting for me that you can see very different dynamics of different markets, coal versus oil, iron ore versus others. But the correlation between earnings and assets is generally quite well correlated. So you can't really ignore what's happening in capes, even if you're looking at handy sizes, because of those cascading effects. And I think that also kind of leans into this question about the Black Sea as well, because as we've said, it's mostly affecting kind of smaller ships at the moment. But then what are the impacts going to be on coal trade? How long would it take for Europe to start accepting Russian coal again in smaller ships? And would that then mean there's less long haul trade in cape sizes in coal into Europe? And then does that initiate a bit more of a redistributed trade back to something more approaching normality, where it should be slightly more efficient? But I must say that whenever there's disruption in shipping or disruption in dry bulk, it's almost always positive, despite maybe having some kind of negative factors where the ton-mile demand will start to favor, start to be a bit more efficient. Actually, disruption will cause all sorts of issues, and you expect it to be quite positive for dry bulk markets. Rahul?
Yeah, perfect. Thank you, Rajiv. I think good point. So we don't focus much on capes, right? I think we don't, maybe I'll send you some of our stuff, because we do things very differently than the research brokers. And we charge 6 times the price that as well, right? So the key here is, I think we are more macro focused. I think China is important, certainly is, because from the macro perspective, right? But I think every dry bulk analyst became a container analyst last 2 years. You just had to be a container analyst to focus on what's happening on the dry bulk market. And if you plot the Supramax chart with the container freight rates, it's like 99% correlation over the last 2 years, right? I think as you started seeing some of that container market roll off, smaller segments started correcting, but smaller segments are more industrial economy. That's essentially doing very, very well at this point of time. The exports, everything, if you look at German exports yesterday to US were record high. Germany is an industrial economy despite the war and everything is going on, right? So dry bulk in that sense is purely macro across the globe. As in we talk about whether it's coal trade, which happened in terms of flows. So we use more of those flows, which are changing. And then you have these all ballast laden spreads. So shipping has become a very analytical on a weekly basis. We are identifying what's happening with different flows as well as positions, right? Longer term is easier. I think it's become much more tactical in that sense. So I'll send you some stuff, Rajiv, to focus on this.
Thanks. Thank you. Copy us and all of us. Okay, Martin, Simon, one of you, whosoever wants to go.
Simon, you were ahead of me.
But before we go, just one question from Amelia.
Yes.
If she's around. One question of mine. I always grew up in shipping, knowing and believing that the Greeks have shipping in their blood. And they smell things. They don't go by bars and charts and tables. Is it still the same in your opinion, or has that changed?
Hardcore, yes, I would say. And sometimes, to be honest, I am critical of that, because it's a shame to have so many data and so many analysis and so many good points, and just people will go with a gut feeling rather than actually reading stuff. And to be honest, I cannot be of judge that. Only the future will be the judge of that. And that's why I also wanted to ask Will at some point if there's any way to include sentiment in his potential analysis, which obviously it's something extremely difficult. But it would be really nice at some point to have a sentiment index and see to what extent people make decisions out of that.
Traders are already doing that, and we are doing it for them as well. So Trafiguras and the Cargills of the world actually are using.
Does it work?
Yes, the machine learning models are 80% correlated. Things have moved, right? And I think that's
it's the gut feeling.
Interesting part of it is even the Greeks are subscribing to it, right? What I mean is we've seen the industry see change over the last 3-4 years, right? As more of these things start coming in. And again, I go back to macro because it all starts from there and then you start looking at it on a daily basis. But what I'm trying to say is sentiment right now in the financial market is really, really bad. But you don't see that in the shipping markets. That's a key difference. Again, if you go back to 2014, I think when the taper tantrums happened, 2013, 2008 and 9, dry bulk asset values over the last few weeks have recovered back to, I think, recovered all the losses they had, right? But if you see the financial markets, the sentiment there has been pretty bad. And it's a banking crisis. So, yeah.
Marley,
guess
very,
that-
very quickly. Sorry.
Yeah.
There's a company called Arithmix, which actually will use machine learning to track news stories and articles and gets this kind of sentiment index from there. That's the sort of work you can find, which is interesting about the impact on share prices. So that's just a
Arithmix. Okay.
Sorry, what was that called? Eurythmics. That was a popular 80s band, wasn't it? What was it called? Sorry.
Arithmix.
Arithmix. Okay. Arithmix. Okay. Thank you.
All right. Okay.
Okay.
Simon and Martin, yes.
Okay, I just wanted to pick up on a few points here. First of all, in defense of my adopted country, or I hope that they will soon adopt me. My impression of Greeks having the sea in their blood. Okay, I will leave aside the poetic view of that. But there is one thing about the Greeks that you have to remember: their investment horizon is longer. Their investment horizon is generational rather than annually or quarterly or elsewhere. So what you may think as being counter-cyclical or counterintuitive in many cases is just basically investing for their children and their grandchildren. And having that long-term view will mean that you are not perhaps going to be focused too much on the figures. The second thing I'd like to say is that Amalia, I know, picked up this idea about sentiment index from a former position that she was in many years ago. I have stolen it, and we are actually using this internally from a broking point of view on the chartering desk. That we actually, it's not about what else is going on, but from a broking point of view, how do we feel about what we are trying to do at the moment? I think this is quite hard to do in S&P, but certainly in chartering, it's a good thing. We do this internally, whether or not this is going to prove anything or not, but it helps us understand how the synergy within the office works, for example, and it's a good guide for us.
Have you correlated that to the market?
This is a work in progress. Let's put it that way. This is something that we're trying.
You also had a blog a couple of years ago on that.
Yes, well, I did. So I tried to do it with S&P, but my own gut feeling was terrible, so I stopped it, and I went back to the red wine. The third thing I would say, I wanted to say about to Rajiv and in particular, the reason why the big brokers do the capes and focus on the capes, because it's easy. It is limited point, it is limited ports of loading and discharge, it's limited fleet, it's a completely almost transparent market in terms of the fixtures itself, because there's major importers and major exporters. You've got it there, it's easy, you can run it through. And you know, if you could ever get your hands on Pacific Basin's internal data, for example, I think you would mind, but they're not going to give that to anybody else. Why? Because data should not be shared willy-nilly in the shipping market, because as Rahul has said, this has huge value, and the value should stay with those that possess it. So I think this is something that you really have to consider. And as far as the final point for Rajiv, which is, who knows what the market's going to do? No one knows what the market's going to do, because if you knew what the markets you were going to do, we wouldn't be here. It would be, you know, we would be selling bananas, I think, as Morten was saying earlier. And I could try and be a broker in bananas. It may be even more interesting.
Let's quickly go to,
Thank you, Simon.
Okay.
Appreciate it.
Simon, in the interest of time, okay, Morten, you want to add anything? Then we go to that.
Well, very quickly, I mean, absolutely on the capes. I mean, it's easy. You open up a Lloyd's list or a TradeWinds, you know exactly what's going on with the cape side market. You try and do that with Handysize, you have to be in the market market. You have to have offices around the world. You have to have people who deal with small charters, small trades, things that never appear on a sort of an average broking report, and that's why it's easier to read Capes. I think it's also partly due to the FFA side where people trade. I mean, the big, the Chinese trade FFA like there's no tomorrow. Iron ore as well, and it's an easy trade in many ways, and therefore it gets attention. And I think also it's unfair that the Capes are carrying 40% of the BDI when actually the number of the spot element of Cape size is much smaller than it is for Handysize, Supramax and Panamax. So, but that's just the way it is, and I think it's the ease with which you can understand it that makes it attractive to analyze. On the data point, I think it's amazing to see all the data that we have coming at us all the time, and we as many people subscribe to AIS systems where you can guess what ships are carrying and that sort of thing. Are we any better off for doing this? I think probably yes, but on the other hand, we also become herd animals. We all know the same at the same time, and that means that when we're bullish, we're all bullish at the same time, we're all bearish, and that increased volatility, which from Simon's point of view should be a benefit because you do more trades if you have volatile markets. And I think that the third thing I would add is on the sort of side of feelings. I think that's a very, very powerful sort of knowledge to have. If you go into an office, a chartering office, you can immediately sense whether it's a good or a bad market. It depends on sort of the noise and whether they're swearing. Some swearing is in the good market, and some swearing is in the bad market. And it's something that is useful to capture, but it's probably something that's best captured in a sort of a human element rather than having a computer or an artificial intelligence trying to sort of work it out. But that's just my view, and I'm old-fashioned, so I'm probably not not right in this.
Yeah. Okay, Rajiv, maybe few seconds, or he's not there. Okay, now we have one question here. I actually do not like to take questions which are anonymous attendee, but this is a good one, so I will just state that. Interesting presentation by Will and enjoyed conversation with Amalia. As we saw it in Will's presentation, scrapping is expected to increase, and owners or professionals like Narsima and Morton are not interested in buying a ship, as they mentioned, of course, due to uncertainties in the world economic indicators. Do you think such a scenario will bring more pressure on demand and supply in the medium to long term, pushing up the freight? It's, yeah.
Who do you want to
understand?
Who
Morton, you can start. You can start. Yeah.
Scrapping, I actually think that much of the scrapping forecast that I see from people who make these forecasts is too optimistic, and I think we're going to have less than what people are assuming, which obviously is bad for net fleet growth. It means that we're going to have more fleet growth than we would otherwise have. On the other hand, scrapping is like a safety valve for the market. So when the market is too low, then you release some pressure by opening the scrap valve, and the opposite. The point is that when you have low scrapping as you have now, and it's basically zero, effectively zero, it means that it can't be, it's already shut. So when you have a strong market, you can't reduce scrapping. And I think that is an important part of the supply and demand, or the supply side going forward. Demand is a fuzzy object. I've commented on this in the past at ICS events in Hong Kong, and the funny thing is demand the demand is actually made up of the cargo that the bulk carriers are carrying. So if you have more bulk carriers, you also have more demand. So one is a derivative of the other, and that makes it very difficult to make these supply demand analyses work, because the demand is effectively a function of supply. It's always been like that, unless you have ships in layup. And on top of that, you have congestion, you have speed and all these other things. But essentially, supply is always in tune with demand, or demand is in tune with supply. And that makes it very difficult to look at them as two individual or separate entities, which is what classic supply and demand analysis does. But that's just an aberration, I suppose.
Yeah, Simon, do you agree with that? I see your hand up.
Okay. Sorry, I was just unmuting myself, which is not normally a problem. I think there's a couple of other things there as well. There is an assumption that people will scrap ships because of environmental regulations coming in. This is not true. Demand for scrap is very messy anyway, because it depends a lot more, but it's more about driving the price for scrap than anything else, because the demand for scrap is, especially in the Indian subcontinent, is due to local price of steel, demand for construction, and so on and so forth. Very simply, however, except in very, very few cases, which I have known to exist, owners do not scrap ships unless it is uneconomical to continue trading the ships. That's the simple point of view. If you have a survey coming up, or you've got some repairs or something like that, and it costs more to do the surveys than you can hope to get from trading the vessel after doing it, then the price of scrap, then the ships goes for scrap. That is the reason why ships are sold for scrap. So I think I just wanted to make that basic point. There are many other assumptions around the theophanthic, or the I will sell a ship because I want to improve the fleet profile. Okay, fine. I want to sell the ship because it's a nasty, environmentally bad ship. Okay, these things do not exist. The basic reasons are economic, and we should focus on that in any model that you try and produce for sale and purchase in the future. That's what I wanted to say.
Thanks. Thank you. Yes,
if I can add, yeah, absolutely. So yes, some very good points. Scrapping is difficult to forecast, and it will only happen when the economics work, when rates are low, and that's going to push ships out. But I think the environmental issue also, Simon's right, that's not going to be the big pressure on its own. It's only if there's a cost implication. And I think if we just pay attention a little bit to the long-term goals of the IMO to reach a low carbon emitting fleet, then at some point we're going to have to scrap a lot of ships and construct a lot of new ships. And so I think you could certainly build a case that maybe we're in a holding pattern at the moment in many fronts as we start to measure CII and learn from it, see how things change. But as we approach the end of this decade, you're going to have a situation where a lot of ships that were built in the sort of mid-2000s are coming up to sort of scrapping age. You've also got the impact of regulations potentially having an impact on the chartering of these ships and the cost. I mean, it's not going to be the next few years, it'll be towards the end of the decade. And then we're going to have, we will need to have, a prolonged period of a much higher scrapping and new ship deliveries over the sort of 20 years, therefore, to meet the IMO goals. So it feels like we are very much in a holding pattern at the moment before all that can happen. MSI's view that scrapping is going to increase the next couple of years is because we expect lower earnings. That's the main driver.
But I'll just add, I think one of the key drivers of scrapping is lower demand. Demand has to be very way off for an extended period of time. It's not the supply side which is driving the scrapping part, right? It's essentially, if you do not have expectations of earnings growing, you will scrap. Like Simon said, it's driven by economics, nothing of this sort of environmental regulation, because all of that rates today are very profitable. Even they've come down off over the last 2 years. The balance sheets are much stronger. You need an extended period of low earnings to drive scrapping.
I agree. We've got 25 million deadweight to be delivered, or 30 million deadweight this year, maybe 25 next year. So if you do have flat demand, then you can still have scrapping increasing.
Certainly compared to what we had 2 years, but nothing compared to what we saw earlier.
Yeah. Okay. Rahul, one last question I would like to ask you, and then I will thank everyone and announce about our new ICS new event. With this capital market activity trending down by more than 75% so far this year, as per Clarksons, do you think investors are very apprehensive, or they do not find shipping interesting?
I think very good question,
especially US.
That's a disconnect, right? And I'm not sure if Simon, others are watching, if you look at the stock prices of shipping companies, they've been battered over the last few weeks. They're down like 20-30%, whereas asset values are up 20-30%. And just in case of dry bulk, right? Despite, I think, right from Pacific Basin to all the big listed shipping companies giving such an extensive dividend over the last 2 years, right? So the market is more sentiment driven. And again, on the capital market side, it's the retail guys, it's not the institutional guys. Oaktree was selling Star Bulk, they were getting out of it. So there's a disconnect between the physical market and what's happening on the financial and the capital market. That market is depressed. But if you go back again, 2008 and 9, all went down in sync. It's not happening in shipping this time, and that's very, very interesting. If it was not for order book and strong earnings profile.
Right. Simon, and after Simon has expressed his opinion, I will have one minute, everybody. We are over the time, but I think in between we did lose some time, so it's okay. So Simon, and after that, everybody 1 minute closing statements, if you can please give.
Well, all I wanted to say is that if you want to find out what demand for dry bulk shipping investment is ask a sale and purchase broker. That is the real guide about the level of inquiry, how busy they are in particular sizes and sectors, the capital markets versus the, and the pricing of that has got nothing to do with the desire for shipping investment. It's a different model, a different thing. Ask an S&P broker, ask Simon Ward. I can give you my number anytime.
Okay, everybody, 1 minute each, starting with Rajiv, then we can, you can jump in yourselves. Okay, Rajiv.
Say that again, I didn't hear you.
Just 1 minute closing statement. What's going to happen to asset values?
Okay.
Just very one sentence, what's going to happen to asset values in 2023 and beyond? Say 2024.
I'm an optimist by nature. And I think we have already recovered 4% in the month of January, February, and about 2% in March. So I'm pretty confident that just as a buy and buy, let me tell you that our hull and machinery renewal was on the 1st of April, and we did not change the value of the fleet. We kept the same value as we had on the 1st of April 2022. So that should tell you where our faith and belief is.
Okay. Right. Narasimhan.
I would agree with Rajiv, and there would be volatility in the market. I think we will be seeing huge volatility because there are so many factors which are unknown, both on the demand side and the regulation side. Supply side is, it's practically everybody's speaking the same, that it's quite supportive. But on the demand side and the regulation side and the actual impact it's going to have on the demand or the reduction in supply. So I'm optimistic about the market in a broad sense, but then it's going to be a market with very high volatility.
Okay, Amalia.
I would say cautiously optimistic with patches of volatility where I would try to lock in when these come.
Okay, fantastic. Rahul?
I would say very positive. When I mean very positive is what I'm talking about, a longer term view, right? I think all real assets are in for much better times because of the high interest rates. Deflation versus inflation. If we go into a deflationary environment, all bets are off. You will see these asset falls by 20%. We have to understand Credit Suisse had $1 trillion in assets. Nothing happened to the world. I was at Lehman Brothers 2008 and my wife is at Credit Suisse right now. So what I'm trying to say is think outside of shipping. This was a big systemic event, right? If we were to see another 3 months and if we were to see a financial crisis come up, then all bets are off. But if we were to survive with a shallow recession, all real assets are going to do very well over the next few years because interest rates are not going to zero anymore. Yeah.
Rahul, that's very interesting. You're encouraging me to ask you one very quick question. Are we going to have GFC in the next few months?
I think this was the time. I think how they moved, particularly with the European Bank, you saw what was probably going to happen. Deutsche Bank last weekend, most of the traders, bankers were not sleeping, right? The CDS, if you watch the credit default swaps, they're all coming. So it's all coming off. If we're able to survive this over the next few months, I think unlikely that we'll have a global financial crisis. No?
Right. Okay. Thank you. Will?
Thank you. Yes, I think I might take a bit of a different view in that the shipbuilding market is cyclical. Prices are very high. We've already talked about no one really wanted to order. There's a lot of container ships, LNG vessels to be built this year, next year, and I think I think we're going to see prices actually start to decline. I think towards the end of this year, and yes, in the long term, I can see asset prices being much higher, and particularly when you start ordering your sort of zero or dual fuel vessels, then yes, we're going to see a higher prices of those assets in future. But no, I think we're approaching a downturn in the shipbuilding cycle, and that's going to put downward pressure on values as well as weaker earnings, I've mentioned.
Right. Simon?
Are you a buyer or a seller?
This typical broker, right?
Okay. My honest answer.
I'm a seller. I'm a seller, Simon.
Okay. Well, my honest answer to any of you is that I don't know, and I would not, and I don't, and I think we can have an opinion and everything else, but I'm in a slightly different position than the rest of you. I don't know. I see many reasons for and many reasons again. The market will decide. That's my honest opinion.
Okay, and last but not the least, of course, Martin.
Yes, thank you. I think I absolutely agree. Nobody knows. The market at the moment is better than it should be. If you open up a newspaper, whether it's FT or you read Bloomberg or whatever, the market is much more confident now than it should be under normal circumstances. And then you ask yourself, are we wrong? I mean, usually in shipping, we worry about the wrong thing. I remember going back in 2006-07, there was lots of talk about Chinese banks, Chinese financing being the issue. Actually, it was Western banks that was the problem. The same thing towards the end of last year, they were talking about Chinese banks, too much debt, too much government debt, all that sort of thing. Actually, it was Western banks that had the problem, apparently. So most of the time we worry about the wrong thing. Optimism in shipping is great when it happens, it makes you feel good, but it's also a curse because if people are too optimistic, something goes wrong. And that brings me back to what I said to begin with, where this sort of curse is perhaps broken a little bit is in the sense that this optimism will not automatically lead to more new buildings, but we do see it spilling now into second-hand values moving up and being essentially higher than they should be at this stage in the market. So that would be my 1 minute, I think.
Yeah. Okay. Thank you. I wanted to ask a question, but I think we are out of time. So just we are going. First of all, thank you so much. Thank you, Martin, Rahul, Simon, Rajiv, Narasimhan, Will. And of course, a big thank you to Amalia for joining us at the last moment. We really appreciate. And can we have a round of applause for her? Thank you so much for doing that. And we must thank Simon for making this happen. Okay, we are going to have two events in near future, ICS Hong Kong. Some of you who are online may not be able to enjoy the second one. Second one is on 12th of May, we are having chairman's cocktails at Novotel Hotel. We'll have about 120 guests. And we are also thinking if Martin and a couple of other people are in Hong Kong, we can organize a quick discussion there or a presentation. So that would be nice. And early May, we are planning to have a maritime corruption webinar on maritime corruption, what is being done and how important it is. And we'll get Brendan Hawley, Deepak Shetty, and all these people who are experts in it. And with that, big thanks again to all the panelists and thanks to all of our participants who have been with us. This is the longest webinar that I have ever conducted. 2.5 hours is a long time, and I'm happy people are still there. And that must be the magic that my panelists have spelled. That's so very wonderful. Once again, thank you so much. And thanks to the IT support, tech support, Abhi. Thank you so much for taking care of us. Bye-bye.
Thank you, everybody. Bye-bye.
Thank you very much.
Thank you.
Thank you.
Thanks.